everyone, and good evening. Really excited for today's session, so thank you for joining today. This is the first part of our Master Your Options Trading Process course. So we're going to start with the options Greeks, and it's going to be largely educational, and it's those foundational skills that you need to enhance your options trading process. This is probably my favorite subject to teach, my favorite subject to talk about. Once you understand options and how options pricing is comprised, this is really the next layer of that, where you take your options process to the next level, where you understand the effects of that options price, if you will. And the Greeks give us that. And then we can apply our knowledge of the Greeks to how we choose our strategy. So strategy selection, as well as closing out your strategy, can give you an idea of directional bias, how much velocity you need. So we're going to go through all of that today. So really excited, and thank you for joining today's session. If you don't know me, I'm Jessica Inskip, the Director of Education and Product here at Options Play. And like I said, we're going to start with introduction to the Greeks, then we'll go through buying and selling options, using technical analysis, and trading vertical spreads. So this is that foundational aspect that you need to take your options trading to the next level. And again, my favorite subject. So nonetheless, let's get started. So as always, we have to start with a disclaimer to know that there are going to be securities that I'm going to use within this presentation. They are for demonstration purposes only, not a solicitation to buy or sell any type of security. So just know it's informative, purely educational. This is not tactical or investment planning advice. All right. So let's start with a chart here. So if you've attended our previous sessions or any of our options play sessions, when we talk about and start introducing options, we show you this chart. Now, this chart is something that you can see when people are taking their licensing exams for the first time. That's when I was actually first introduced to it about a little more than a decade ago. It's a way where you understand how each component works. So let me break it down for you. We put calls on the left-hand side and puts on the right-hand side. We put long calls on the top, short puts on the top, and then the inverse. And what this chart is essentially a tool for understanding all of options. So you'll notice that there is a bull here and a bear there. So bullish strategies are found at the top and bearish strategies are found at the bottom. Then we've got some goals associated with these. So what you use this for is when you're learning options for the first time or you're advancing options, if you understand how a long call works inside and out, you can utilize this chart to really put the puzzle piece together. So there is a mirror essentially across this chart that you can utilize. And there are a lot of common elements that you'll notice to options. So let's talk about that as well. Long calls and long puts, they're purchased. I love to add that a definitional element to that. So anytime you say long, think purchased. Anytime you hear the word call, think right to buy. Anytime you hear the word put, think right to sell. And anytime you hear the word short, sold. So we put that together. So you'll notice that the long options right here, they're the opposite. A long call is bullish. It's purchased for a premium. So you've purchased the right to buy an underlying security. A long put is bearish. So the opposite. It's purchased for a premium and you purchase the right to sell a security at a predetermined price within a specified time frame. These long options also have a lot in common. So your goal is for the underlying security to move more than what you paid for that option. So that's important to know. And because you need it to move more than what you paid for that option, that means you need a sharp directional movement in your favor. So for a long call, we need a sharp upwards movement because we want it to be the right to buy at a lower price is better than a higher price. So if the market is at a higher price, that means our long call is going to go up in value. And then the inverse is true with the long puts. So we profit from a sharp downwards movement, because if we have the right to sell at 100, but the market is down at 80 and keeps going down, this right to sell at 100 is going to go up in value as the underlying security moves down. So this means that long options, you'll see that this common goals attached to them is a sharp directional movement. And then we also say time decay is negative, because, and we'll review options pricing as well, just to make sure that we cover that together. But whenever you purchase an option, you're also purchasing time, and time decays as we get closer to expiration. So that means if I'm buying something, I need to close out of that option so I can recapture that time value as it decays, because it's going to immediately leave me as soon as we get to expiration. When your option expires or on the day of expiration, it is only worth its executable value or intrinsic value. Whereas those extrinsic value components, which is time value and implied volatility, that is removed as we get closer and at the date of expiration, which means that's a negative factor for anything I've purchased because it's a decaying asset. And so now you can see how the inverse applies here for the short puts and the short calls. They're short, so they're sold, so we keep the premium. And so my goal is for the option to not have value. So we want it to expire so we can keep the maximum credit. That means time decay is positive, because as we move closer to expiration, that option is going to lose value, which is good for me because I sold it for a credit and I want to be able to buy it back at a lower price. Now, as far as profit goes for the short calls or the short puts, they have a slight directional bias, but they're actually neutral in addition to, meaning you simply want it to be worthless. So for example, of a short call, so we'll go back to that definitional, that means I sold the right to buy, so I am obligated to sell because I have to fulfill the terms of that contract, which means I don't want it to have any value. So, all right, so we were talking about how you can utilize this graph to understand everything and the components of options pricing that are found within this T-chart. So the important takeaways from this is you can focus on long calls. If any of this seems foreign to you, you can utilize this chart to figure out the rest. Long options profit from a sharp directional movement to your directional bias, if you will. Because options are purchased, we also purchase time. That works in favor of the short options, but it hurts long options. So time decay is negative for long options. It's positive for short options. So that's what I want you to take away from that, as well as understanding that long calls and short puts are bullish, short calls and long puts are bearish. And this is all on an individual basis. And today we're going to talk about layering them together and looking at that directional bias and how to use that with the Greeks. But this is the introduction foundatory elements that you need to know before we move on. So I appreciate you rejoining, and I apologize about my internet connectivity there. So let's talk about why study the Greeks. So first of all, it's options pricing, as we've been discussing. So if you understand the components of what makes up an options premium, which is the intrinsic value and extrinsic value, which we will review in a very brief moment, we can utilize our knowledge of the anatomy of an options premium and then the effect of the Greeks. And if we know how the external factors are going to impact how our options premium moves in value, then that can really, really take your trading to the next level. And that's the way you can determine, if you're going to have a buying versus selling, when you layer on technical analysis. So everything that is utilized or set up within this course is a component of that. That helps with strike selection. So now if you understand how the Greeks are utilized, that will help you determine which strike. So you'll graduate from looking at, oh, okay, I see resistance at this 20 level to let me look, I see resistance at this 20 level, but let me layer on a Greek to choose my strikes rather than just price movement. So it's another component to your process that advances it. And once we have other components that confirm and rhyme and agree, then we have a really solid process because there are multiple steps involved. And then, of course, position management. So like I said earlier, if you understand the Greeks, you can get an indication of when to close your option. You can get an indication of risk. A lot of times we hear the words gamma risk, so we'll talk about that as well. But it also gives you an idea of risk assessment for your position holistically, in addition to your portfolio. You can even do that as well. So let's do a quick review of options pricing. So, and you can refer back to that previous slide and have it in your mind and focusing on a long call, which is what we're going to focus on right now. So let's say we have an underlying security, we call it ABC, and it's trading at 103. And we have this ABC option with a 30-day expiration, and that's trading at 5. So we need to understand what comprises that premium. And we have all the information we need. We know the actual value of the option, because we have our strike price. So this represents the right to buy 100 shares of ABC at 100 at any time within the next 30 days. And so our premium is made up of intrinsic and extrinsic value. Intrinsic value is just another word for in the money value, which just means executable value. So the executable value of this contract is $3. Because it contains the right to buy at 100, I can immediately sell at the market at 103. So that means the in the money value is $3. And remember, this could be 0. Those really far out of the money options that are very far away from the current market price, that's going to have 0 intrinsic value. So that's important to know. Then there is extrinsic value. So this is external factors that affect the options price. And it's mainly comprised of time value and implied volatility. Dividends also has an impact, and interest rates as well. And even though we're in a higher interest rate environment, it still doesn't have a large impact. And we can talk about that as well. So extrinsic value is anything in excess of the in the money value. And remember that in the money value can be 0. So in this case, it's 2. So this 2 is a decaying factor. This 3 is a constant factor as long as ABC remains at 103 or moves higher, then this will go up. So this in the money part will move in value based on the underlying security. This extrinsic value, this $2 is going to deplete as time expires, as we get closer to expiration. However, because of implied volatility, it is possible for that to also move up. And we'll talk about that as well. So this is what we want to understand is we know what comprises a premium, intrinsic versus extrinsic. How do these change and how do these move? And that's what the Greeks tell us. If that makes sense to you, it's very important that we understand this fully before we move on into the Greeks. Please type a 1 for me in the chat window. So that is a 1 in the chat window. Lots of 1s. Thank you for that. All right. So now I made you a little diagram just to give you an idea of what affects an options premium. And we're going to actually relate these to the Greeks. And hopefully, if you want to answer these together, you can even throw it in the chat as well. Normally, when I give this one in a live audience, we do that. So if we have an event where the stock moves above the strike price, so what type of effect does that have on a long call? Is it positive or negative? So if the stock moves above the strike, what happens to the long call? It's going to be more valuable, right? Because if we have the right to buy at 100, and then if the stock keeps moving above the strike, that means the right to buy is at a lower price, keeps getting lower. Therefore, that long call is going to be more valuable. Now, the long put, that's going to be less valuable because as the stock moves above the strike, that's not what we're looking for because we have the right to sell. If you can sell at a higher price at the market, the long put's going to go down in value. So what happens if the stock moves below the strike? The long call is going to be less valuable. The inverse is true there because we have the right to buy at a lower price. If the market is at a lower price, then that's going to be more valuable. So as that, which is going to deplete the options value. I know I just made that a very confusing statement, so I will repeat that again. If the stock moves below the strike price, that means the market is better off buying the shares at the market versus executing upon the terms of the contract to buy the shares. So therefore, this is less valuable. However, that makes the put more valuable because we have the right to sell. And if it's at a lower, the market's going down, then my put's going to go up in value because it has I can sell it at a higher price. Now, if there's less time until expiration, we know that for both the long call and the long put, that's going to make it less valuable because we purchased them. Makes sense, right? And then if there's an anticipated movement, like earnings, it makes both the long put and the long call more valuable because that, think about if you have an option, and then as we get closer to a underlying security reporting its earnings, on earnings, we have analyst expectations. So we expect the option to move up or down in either direction, depending if it meets analyst expectations. And we have a predetermined date. Because of that likelihood of an anticipated movement, it causes the options to be more expensive. So that's a spike in implied volatility. And as that implied volatility increases, it makes long calls and long puts more valuable. But the inverse is true, and we call this volatility crush, is once that anticipated movement has happened, so now there's no longer anticipated movement, that implied volatility component of the premium just immediately goes away, which makes sense because you've already, the stock reported, maybe they did really well. So now any of that anticipated excitement is gone because we know the results. And that causes a lot of people get burned from earnings because of that. And we call that volatility crush. So what's important here is just how do these events affect options? And we'll translate that over. And I've got it separated into internal and external for you. So let's start with delta. So delta answers the question, how much does my option move if the underlying security moves by 1? So just the change, if you will. So let's go into a little more detail. So the definition says it's a theoretical estimate of how much an option value may change, giving a movement, a one move up or down in the underlying security. So if the underlying security, I've got XYZ here, moves up by 1, if a XYZ call has a 0.3 delta, that means it moves up by 30. If a XYZ call has a 0.6 delta, that means it moves up by 6. And then the inverse is true. If it moves down $1, then that's how much it changes. So there is a question I get quite a lot when people first start trading options, and we never would answer it with delta, but it's why does the option move in tandem with the underlying security? And the answer is because your option is priced by more than just what the stock does, which is what we saw as we reviewed options pricing. So if you want to know, okay, if the stock does move, how much will my option move? That's what delta tells you. And it's also used for a variety of reasons outside its definitional aspect. And I'd say delta is probably used, delta and theta, more than others, but delta is probably the most important to understand, and that's why we start with it. So delta values, you'll see them on an option chain. They range from -1 to +1. That is it. And positive strategies or bullish strategies are going to be closer to 1. So I call that greater delta values. Whereas bearish strategies are going to have a negative delta value. So on this side, and anything that's neutral will have a 0 delta. And so we can use that to really get directional bias, which we'll go into a lot more detail. But think about the logic behind that. If we have something with a 0.5 delta, that's an at the money option, and I'll show you on an option chain. As the option goes up in value, so as the security moves in our favor, it's going to get closer to 1. So we want greater delta values when we're buying options. So if I'm buying a call, I want delta to get here. If I'm buying a put, I want delta to get here. And something happens, and we'll talk about that, but that's the goal. So, and that's what the Greeks will tell us, and that's what the option does. So as your strategy profits, delta values are essentially greater. Now, your option, we'll talk about that in a moment. So let's pull this on an option chain. So, it's going everywhere. All right. So this is an option chain where I pulled 30 days out, and this is evergreen content. So I want to go through the values of delta to get you an idea. So this 32 strike right here, this is an at the money option. So this security is at 31.73. So it's as close to at the money as we can find on this option chain. Most at the money options are going to have a delta close to 0.5, which is completely logical. If you think about it, delta is, if you are in the money, it's going to get closer to 1, and as you're out of the money, it's going to get closer to 0. So therefore, 0.5 delta, you can just move a penny and you'll be in the money or out of the money, or you'll have executable value or non-executable value. So you can use that to say, okay, well, this is my probability of being in the money or not at expiration. That's one way it's used that we'll talk about. But let's look at the way it is in a real life application. So I just went through the at the money option, the 32 strike delta with 30 days left until expiration. This is about a 0.54, so the closest to 0.5 delta. It has no intrinsic value because there's no executable value. The right to buy at 32 is not more advantageous than the market price of 31.73. So that means the entire extrinsic value or this entire contract is only worth extrinsic value, so about 291. Now, if we go into the deep in the money options, this is a 19.5. So the right to buy at 19.5, while this security Shopify is trading at 31.73, that has a delta really close to 1. And if we were to go really farther in this option chain and get to the very low strikes, you will find a delta with 1. And you'll notice that this is pricing in very little extrinsic value. And the price is almost fully executable value, because we have the right to buy at 19.5, sell at 30. The intrinsic value of that is 12.23. Excuse me, right to buy at 19.5, sell at 31.73. So the executable value is 12.23. If it's pricing at 12.43, that means only 20 cents. That difference is extrinsic value. So therefore, this option has lost this component, and it tells you where this is really centered. Now let's look at an out of the money option. And this isn't as far out, but it's still out of the money. We're looking at a 0.3 delta. So we have a smaller delta. We have the right to buy at 37. The market's pricing around 32. So the market is much better. This has got a long ways to go before we get to 1. And so this extrinsic value is this entire options premium is a completely extrinsic value, is 118. So essentially what this is telling us is my destination, if I'm buying an option, is here. I want this to happen, and not here. So you can use that for probability perspectives. And again, we'll go into that in a little bit of detail. But what I want you to see is the pricing components of it. A deep in the money option, an option with value, has a greater delta value. The at the money option has about a 0.5 delta, and out of the money has the lowest delta. And that makes sense, farthest from your destination, right? So how would I use delta? How are we actually going to apply this? And on options play, I'll show you the tool where we have all of the Greeks as well. One, assess directional risk. If you're layering in options together, so if we have a straddle, for example, or we'll go into some examples, we know bullish strategies have a positive delta and bearish strategies have a negative delta. So if we're trading multi-leg options, we can put them together and reveal if it's a positive or negative delta, and it will tell you if that strategy is bullish or bearish and get some velocity behind it. So for example, covered call. A short call individually is bearish, right? So it has a negative delta. But a long stock has, and this is the only Greek that we'll talk about with stock, long 100 shares is equivalent to a delta of 1. And that is an important component that I need to go back to. So a delta of 1 means that your contract is beginning to act like the stock, which means as your stock moves $1 or 1, the option premium will also move 1. That means it's acting like the stock, which happens when it gets very, very deep in the money. It starts losing its extrinsic value. And you probably noticed that on the option chain when we were going through each of those examples. You'll notice that the extrinsic value was the highest at the money options. That's because it's where it's centered. And again, makes sense. So our short call individually is negative, a negative delta, but by adding the long stock, this actually takes over the entire strategy and makes it bullish, which makes perfect sense, because when you buy stock, your goal is for it to what? Go up in value. And when you sell a call against those stock, all you're saying is, I agree to sell those shares at this strike price. And so your goal, you reduce your net deltas in this case. So in this example to 0.7, you are giving yourself a stopping point at a higher strike, and you can use lower deltas to decide that optimal stopping point, because you want to prioritize stock movement in addition to capital appreciation, which you would have learned in the previous course. And delta is used for so much. So this, we'll spend the most time on delta. Now this is a long at the money straddle, which is just a long call and a long put with the same strike and expiration. However, as you noticed before, I can get really close to 0.5, but not necessarily. So if I was choosing a real straddle or trying to get that, by definition, it would not be a straddle, maybe a strangle. You'd look for a 0.5 delta or look for a delta for 0. That means you're truly neutral. I mean, you can profit from a directional movement in either side. However, this straddle has a directional bias, very slight directional bias of 0.1. So this is actually, even though on the surface, this looks like you can profit from the security moving drastically up or drastically down, you're more likely to profit from it moving drastically up because we have a directional bias. Can also use to assess traction, so stock sensitivity, which makes sense. If we have a delta of 1, that means we're acting like the stock. So it's equivalent to being long stock or short the shares. And that happens when we're on either side of the spectrum. So for the call side at the +1, for the put side, -1. And most importantly, one we talk about quite often and what you'll use for covered calls and cash covered puts is assessing the probability of being in the money at expiration. So a higher delta has a probability of being in the money at expiration. Makes sense because it's already in the money, right? A 0.5 delta has a 50% chance because it can move up 1 penny or down 1 penny and be in the money or not. So that, again, makes sense there. And then a lower delta is very far out of the money, which means it has a lower probability of being in the expiration. So if your goal for selling options is for it to not be in the money, you want something with a lower delta because that gives you an indication this has a lower probability of being in the money or higher probability of expiring worthless, which is the goal. So that's how you can use probability of in the money at expiration to select your strike prices. All right. And this is where I just like to throw these on the chart and we'll build this together. So would love for you to put this one in the chat. So we'll start with long calls. Does this have a positive or a negative delta? So in the chat, just put positive or negative for delta of long calls. And I hope you get this one right. See some positives. Great, that is correct. Sorry, I'm giving ample opportunity. And that's true for anything found on this side. So this is where this chart is very helpful. So positive, any bullish positions have a positive delta, which means any bearish positions have a negative delta. And that makes sense, because that's where we want it to move in order to have value. And think about that. We have a positive delta. We want delta to get more positive, so move closer to 1, which is going to make this have value. A put has the most value when it's closer to -1. So if it moves closer to +1, that means it doesn't have value, which is the goal for short puts. So it gives an indication of direction that you need, and you can start combining together to understand this is my directional bias. You can do it with your entire portfolio. You can assign, if you have so many contracts on one security or the market, you can literally give yourself a directional bias of what you're looking for. So let's talk about theta. And we will not spend as much time on the rest of the Greeks. Delta is probably the most important, so I want to make sure we talk about that. But theta, by definition, gives us how much does my option lose each day as it approaches expiration. So remember, we were talking about options pricing. We said that time value component decays every single day. This is the dollar value that tells you the daily decay. So by each day, it decays by exactly how much, assuming all else equal. Same factors here. If 1 day passes, if we see an XYZ call with a 0.3 theta, that means the options premium is going to move down by 30 cents. Same here with 0.6. That's simply all it means is daily decay. How is it measured? So it's measured by dollar values. This can be any high amount. When Amazon was in the thousands, I'd see theta with sometimes $20, very, very high values, because it's literally just the daily value of decay. And remember, if we have decay of an options price, that benefits sellers and hurts buyers. So what side of the coin do I want to be on? If I have multi-leg options, remember, time is always working against you. If I can find a way to get theta positive for me, then you're making that time decay that hurts you suddenly move in your favor. So that's how this one is helpful for strike selection. So let's talk about that. So here's the events that we had earlier. If we have less time until expiration, that makes long options less value. We talked about that. But theta will increase because the theta is not linear, if you will, meaning the daily decay doesn't happen at the same rate every single day. It starts like this, and then as you get, it's about 14 to 21 days until expiration, it starts falling off a cliff. And that's for an at the money option, which means that at some point, this is going to rapidly increase because it's going to immediately go away as we get towards expiration. So there is a negative impact on those long options that we just have to be cognizant of. And that extrinsic value is going to accelerate. For buying options, we want to make sure we close out our options before that happens, because we want to sell to close time value, recapture some of that time value that was already purchased. For short options, we want to make sure that we account for that spike in theta, but increase in deceleration, so we can buy to close it at a lower price. So this is what goes into those best practices that we'll be sharing with you throughout this series of time frame, of where we specify options contracts time frame. So for buying options, normally it's 60 days, and that's to account for that theta decay, to make sure that it doesn't hurt you and you can sell to close within before getting collapsed by losing that value very rapidly. And for short options, it's around 45 days. That way you can allow for some theta decay, because that helps us. And again, this course here, or this session 1, is the foundational elements. What I just said is going to be reviewed in subsequent series. So let's look at this again on an option chain. Now this is different as far as where theta is. And if you would have noticed before, I kind of teased it up when we talked about delta and how the extrinsic value is mainly here. So you notice that that is the highest extrinsic value is found at the middle option. And that's because theta is centered around at the money options. And you can see that here as theta gets smaller here and smaller as if we were to go out all the way here. So that's all I really want you to take away from this. If we have a really deep in the money option, it has a smaller decay, and that makes sense. There's less to decay because there's less extrinsic value. It's starting to act like the stock. We want to make sure we close out our option before this happens, because we want to recapture this. So that's important to know the velocity that you need. The at the money option has the highest because it has the most extrinsic value around it. And then the very far out of the money has a lower value. Well, in this case, it's not showing the same, but if we were to compare maybe a 0.03 here, that has still theta decay, and it's the only thing decaying of the options value. So this is actually going to rapidly increase as we get to the front month, which just means the option that's closest to expiration. And I have this example here. So you'll notice very sensitive, this is showing the same options, or the same option chain, but with a day before expiration, or the day of expiration. And you'll notice the theta column is immediately 0 with absolutely everything. The only thing that really has any value on the day of expiration is delta, which makes sense. Delta has moved to 1. So it's either in the money or not. That's the best way of saying it. If you're in the money, you've got a delta closer to 1. You're not. Very, very little. Theta has very little to decay, and these options are only worth their executable value, and that is it. So that theta rapidly increases as we get to expiration, and then time value is completely gone. And that's what this depicts. So how would we use this? One, I hope you gathered this, is assess my extrinsic value exposure. I know that long options have negative theta, which means time value depletion hurts me. That's all that means. Short options have positive theta, so daily time decay helps me. And my combined contracts can tell me if I have positive or negative time exposure. That it is as simple as that. So for example, this bull call spread, this is where we can help with strike selection. And this is what the tool is completely designed around. If we have and these are 30-day options, the right to buy at 100, that has a daily decay of 0.05. Well, if I sell an option against that, this is still a bullish strategy altogether, but I'm reducing my theta exposure, my time value decay. And that's a great example. The Greeks really just show a lot of the best practices that we teach is you are reducing your time value exposure, or that decay that's working against you, because I'm selling an option and collecting premium, which means that velocity movement that I need is less because I'm spending less money, less risk exposure. Makes perfect sense. So I don't need the option to move as much because I need the option to move more than what I paid for the option. So if I sell something to reduce the amount that I paid, I need it to move less. And additionally, if I can remove the goal is I'm removing as much time value as I can that I purchased with allowing the right velocity exposure. And there are very rare instances where you can have a bull call spread and even have a positive theta. So that's where I'm saying you can utilize the tool or best practices to know how the option is affected with pricing. So that's how you can utilize theta specifically, but all the Greeks to choose your strike prices. The bull put spread. So this has a positive theta. This is a sold option. Strategy driver here is the short put. So the right to sell at 110 is, and that's a good trick for looking at multi-leg options to see what the strategy is. It's always the most expensive option or the most valuable option. So selling at 110 is more valuable than selling at 100. Therefore, I know that this is a short put credit spread. That's the driver, very little information. That means that, and these can also move, and we'll talk about that as well. But this has I'm reducing my theta exposure, that daily decay, by buying that option. But this is different in this scenario. Instead of capping my gain potential, I'm mitigating my risk exposure. But I still want to keep theta positive. That's the goal, keep theta positive. So let's talk about theta from a positive and negative value. So for long calls and long puts is theta positive or negative. And you can just put a plus sign or a negative sign in the chat box. Theta positive or negative. All right, nailed it. It is negative, which means it's got to be positive for short puts or short calls, just short options in general. So let's go on to gamma. I love gamma. I think it's my favorite one to talk about. But this tells us the rate of change of delta. So if the underlying moves by 1, delta tells us how much the options premium is going to move. Gamma is going to tell us delta's new value. But it can be used for so much more if you just understand delta really well and how it works, which I hope we've done that. So just the definitional, I already gave it to you, represents the rate of change between an options delta and the underlying assets price. So if the underlying security moves up by 1 and has a 0.2 gamma, that means delta moves up by 0.2, 0.08, delta moves up by 0.08. So it's just the new value of delta. We don't need to know the changes of it. Gamma is also on a scale from -1 to +1. Long options have positive gamma, and think of this as to why, and this is how we can use it, and we'll start triggering that in your brain, is it's going to tell us if we have a higher gamma and the underlying security moves up, that means we got our delta closer to its destination, which is going to be +1 or -1. So on the call side, let's focus on that. If the underlying security moves up, gamma is going to move up, which means our delta might have moved from 0.5 to maybe 0.7. So that's closer to its destination. That equates to risk for short options. Because remember in that previous chart, I said there is a sharp directional movement that is needed for long options. Short options have a slight directional bias. So a short call is profitable when it expires worthless, which happens if the underlying security is literally just 1 right below. It does not need a huge movement. It just needs to be directly underneath that strike price. And so that's why gamma, since it tells us how fast delta is going to get to its destination is negative for sellers, because if we're going really, really fast, we don't need that. But for buyers, we want to get to our destination quicker. A great analogy is it's the acceleration, if you will. So delta is our destination. We want to know how quickly we'll get there. If we have a higher gamma, we're in like a Maserati, we're going really, really quickly. A lower gamma, we're in I don't know, a car that doesn't go too, we're in a golf cart, or maybe a bicycle, just not going there very, very quickly. So a higher gamma means it's really good for long options because we want to get to that destination. But a lower gamma means we've got a lot farther to get to that destination. And if we have getting to that destination is positive for long options and negative for short options. That's also why we call it gamma risk. And we'll talk about that more. Gamma squeeze and all of those things. So the event is, if the stock moves up, that's going to it's going to make your long call more valuable, makes your long put less valuable, which means it has for the long call side, it has a positive impact, the negative impact on the put side. And it's all about payoff profile. So let's look at gamma on the option chain. And remember, this is gamma is acceleration. So if gamma's job is to get delta to 0 or 1. So now that we know how delta works, think about that. If for a long call, if delta is at 1, that means that gamma's done its job, so it's going to go to 0. So it's already at its destination. There's no more further to go. If delta is at 0, gamma has a long way to get to its destination. A delta of 1 means, and at expiration, means it's worth value or not. Is the option worth value or not? And gamma is going to get it there one way or the other. So it's going to get the option to 0 or 1 at expiration. So what this means is, if I'm buying an option, I want a higher gamma. And that's how you can use this to purchase strike prices. If I'm selling an option, I don't want that velocity, that's risk. So if you'll notice that it is too centered around at the money options, and that's because they have more velocity. So that's where sometimes when we start talking about delta, and you'll see that, oh, there's no extrinsic value priced into really deep in the money options. Well, that's because they're already at their destination and they've lost their velocity. And since long options benefit from a sharp directional movement, something that will tell me that sharp directional movement will benefit this option is a higher gamma. So that's how you can utilize gamma. And you'll see again that this one is centered around at the money options. And it's depicted here, of course, with the examples on the right-hand side. Such a sensitive mouth. So that's deep in the money option. It's already at its destination. Gamma is very, very low. There's a higher gamma for the at the money option and a lower gamma that's farther out. So you can see that it's centered around, and that's because we've got some velocity to get us here, and gamma has a long way to go if it's further out of the money. So that's also another great example as to why buying really, really far out of the money options aren't necessarily the best idea, because you need a lot of movement, and that's depicted by gamma. And then I have that screenshot again of the front month options. And this is also another great example of gamma also increases as we get towards expiration. And that's why there's gamma risk for short options, because that means I could be very profitable if I sold a 32 call, because it's not going to be worth it. Buying at 32 is less advantageous than this market price of 31.76. However, it has a high gamma, which makes sense. If there's little movement, that will all of a sudden make me unprofitable because extrinsic value is completely depleted. Basically, I'm at my destination. I have no reason for holding this option. It's just an example of why we do not hold options until expiration. long or short. It's either at its destination or it equates to risk. Excuse me. So you'll see how gamma is its highest at expiration, which again makes sense. If there's no extrinsic value and the underlying security just moves by $1, that's going to move just like the underlying security. And I'll move on because I know I can talk quite a bit about gamma. So how do we use that? Long options have positive, short options have negative gamma. So velocity helps me if I'm buying options, hurts me, it equates to risk if I'm selling options. Combined strategies can tell me if I have positive or negative gamma. So with this knowledge, if I have a net strategy that I purchased, so a bull call spread, which means this is the strategy driver here, I would like a positive gamma in that situation. If this was inverse and a bear call spread, I would want to make sure I have a negative gamma. Like you need to layer them correctly. So velocity is still there. So this means if we were to put these on the chart and put them together, I'll pose that question again. Do long hauls have positive or negative gamma? Positive, positive, perfect, that it does. As do long puts. So long options, regardless if they're a call or put, have a positive gamma. Short options have a negative gamma, regardless if it's a call or put. And that's because it's velocity. And that makes sense. You can see how these all equate to the goals that we put up here. And then I know we're right at time, so I will spend the smallest amount of time on Vega. But Vega just tells me how much volatility affects my option. So just not to be confused with implied volatility. It measures a 1% point change in implied volatility. So similar to gamma, just applied to IV. So if IV moves up by 1%, one point, and we have a call with 0.17 Vega, it means the premium moves up in value by 17. So that is just literally the volatility exposure. So when we were saying earlier that an increase in implied volatility will benefit something that I'm purchasing because it makes the premium go up in value, that's what this depicts. So that means that it is good for the buyer. If there's an increase in the premium, that's going to benefit me, can hurt the seller. And then the same is true. It is centered around at the money options, and it has the highest impact actually the farther out. So implied volatility affects the longer dated options. And then combined can tell me if I have volatility exposure or not. So that's what I'm looking for. Is an increase in implied volatility going to hurt or help me? And sometimes that can give us an idea if an option is expensive or not, which we'll go into more detail on the next few sessions. I know I flew through Vega, but these are put in order of importance. So Vega is positive for long options and negative for short options, regardless if it's a call or a put. So those are the Greeks that we're going to cover today. I will put this on the screen before we do the quick recap. I gave you a lot of foundational elements of how the Greeks work. And know that options play was built by you do not need to know all of that. I showed you an option chain, and there's just so much technology, and that's the data that we built, where you don't need to look at an option chain that way anymore. It's important to know what these underlying movements are utilized for, and it can help expand your process. However, within the tool itself, we have a completely different way of viewing the Greeks. That way it points out what is necessary. So you can access options play at www.optionsplay.se. And then we have a lot of good educational resources that are there. But I do want you to know that this tool is built on utilizing a lot of that, and we teach with the Greeks. So therefore it's important for you to know, and this was purely foundational and can be applied. Tying everything back together, and I think this is important to note, and this is just a helpful screen, is the goals of your option are tied to the Greeks. That's literally it. So if I'm bullish, positive delta. If I'm bearish, negative delta. If I'm buying an option, that's going to hurt me, that time value. So negative theta. That's simply it. So time decay is negative. That helps me if I'm selling the option because it goes down in value. I want velocity. I want a sharp movement if I'm buying options. So gamma is positive for purchased options and negative for short options because that's risk. A sharp movement means I can be in the money really quickly, and I don't want to be in the money if I am selling an option. So I want a smaller delta, positive theta, and very little gamma. And then vega, an increase in implied volatility, makes the option go up in value. So that's positive for long options. And if an option goes up in value, that is negative for short options. So that's it. So I hope this gave you a really good understanding of the Greeks and how they work and implied and affect the options premium. The purpose of starting with this is, again, it's a foundational element, and it is intermediate even to that advanced side, but it's where a lot of our calculations come from. We'll talk about reducing these effects and working in your favor as you layer on options. So that's what we're going to go into next. So I will open it up for questions if you have any. I will leave this one on the screen. And again, I apologize about my internet popping out earlier, but I do appreciate you to take the time to learn this. Again, it's my favorite subject. But if you have any questions, feel free to put them in the chat window or the Q&A. And I thank you again for the time. And there will be a recording sent out afterwards, as well as access to the slides. And if you did sign up for this course, you should be automatically registered for the next one, in which case we'll really talk about applying these. All right, well, we did go 5 minutes over, so I appreciate you staying. Thank you so much for the time. Have a wonderful week, and I'll talk to you soon.